Here's a home buying tip that even some of your most seasoned mortgage professionals are not aware of. In the United States, many of the loans that are financed are underwritten to Fannie Mae or Freddie Mac guidelines. And both those entities have what we call AUSs, automated underwriting systems. So the first thing a loan officer will do is have you take an application, we collect documentation, and then we make sure that everything looks good within the application. We pull your credit. And one of the first things we'll do is run you through our automated underwriting engine. One is called DU for Fannie Mae, the other is called LP for Freddie Mac. Now, sometimes what will happen is the algorithms will not approve somebody when there's like 3%, 5% down. They can be very stringent. So we will get what is called a refer eligible. Which means at that point, the loan cannot move forward. You're not being approved. However, there is a very simple hack that actually helps a lot of people that many loan officers are not aware of. And it goes like this. If most of the loans that we underwrite are a 30-year term, so people have the lowest payment. Well, if you shorten that term to 25, 20, 15 years, it's not unusual we'll get an approved eligible, which means we can move forward. As a matter of fact, just last week, an old colleague of mine gave me a call, and he was running into this exact circumstance. And I said to him, why don't you go ahead and run it on a shorter term? Day later, I get a call from him, got approval on a 20-year term. He was happy. His clients were happy. Now, something that you have to bear in mind, on the shorter terms, you are going to have a higher payment, okay? But it is a better situation than not being able to make an offer at all and being approved, as well as, the recourse would be going maybe to an FHA loan, which is not a bad loan, but if you can avoid it, FHA has upfront mortgage insurance. It has a monthly mortgage insurance that will never go away based on those, the lowest down payment. So conventional doesn't have that upfront MIP. And unfortunately, in many parts of the United States, realtors are a little bit, they don't like necessarily looking at FHA offers. They prefer a conventional offer. So to put our clients in the best position, I always look for a conventional loan first, if we can do that, okay? So there's a little hack, little tip. Yes, your payment will be higher, but you'll have more money going toward principal reduction. And one of the reasons this happens is Fannie Mae looks at, years ago, they looked at, when do they foreclose upon people? And often it happened within the first 2 years. And when you're putting 3%, 5% down, and maybe that's a flat market, not a lot of appreciation, and there's some parts of the United States, there's not a tremendous amount of appreciation. If that person is going into default within the first 2 years, they don't have enough equity in the property to pay the realtor commissions and then get out from under it. So the property gets taken back. Where if you're on a shorter term, more money is going toward principal reduction. You have a greater equity position. Now you're able to pay the realtor commissions, sell the property, and get out from under it. So Fannie Mae recognized that on the shorter term loans, they have less default, and people are able to sell when they run into a life event that makes them get out from the property. If you found this information valuable, please go ahead and share this information with anybody that you think might benefit from it, and subscribe.